Welcome to this presentation in comparing the common size income statements of Saudi mobile network operators. This presentation covers STC, Zain, Mobily, and Go Telecom. In the previous episode, we compared the revenue and net income of the four operators STC, Mobily, Zain, and Go Telecom. We also compared the net income for 2023 and 2022, and then we also compare the increase or decrease from 2022 to 2023. We move to the financial ratios. We compare the profitability financial ratios such as gross margin, net profit margin, operating margin. We explain the equation for each one of them and the meaning of each one of them. Then we compare the values for 2022, 2023, and the increase and decrease or decrease from 2022 to 2023. We did the same for return on capital employed and return on equity. Then we shifted to liquidity financial ratios such as current ratio, quick ratio, net working capital. Also explained the formula, the meaning, and then we did the comparison between 2022 and 2023. We moved after that to risk, leverage, and solvency financial ratios. We discussed financial gearing and debt to equity ratio. We concluded with some other ratios such as ROTA and asset turnover. If you want to watch the previous episode, you will find a link to it here in the top right corner. In this episode, we're going to compare the common size income statements of the very same Saudi mobile network operators, STC, Zain, Mobily, and Go Telecom. So we're going to compare the income statements. Are you ready for this comparison and for this episode? If you are ready, please have a seat in this very nice airplane and do not forget to fasten your seatbelt as we are about to take off. Alright, so what you see in front of you is the income statements for the four companies STC, Mobily, Zain, and Go Telecom for the year 2023. In the first column, we have the item like revenue, cost of sales, gross profit, operating profit, profit before zakat and income tax, net income. And we have the figure in 1,000 Saudi Riyal. It's obvious that it's not easy to compare those numbers and get insights out of it. So we will go to a technique called common size income statements. As you notice here, the revenue for STC is different than the rest, and that's why the numbers are different. And from those numbers only, we cannot compare. So what we're gonna do, we're gonna divide each and every figure in the income statement by the revenue. So we'll divide revenue by revenue, cost of sales by revenue, gross profit by revenue, and so on. We'll do the same for Mobily, we'll do the same for Zain, and we will do the same for Go Telecom. After that, we're going to compare percentages, and by that we will have a common size comparable percentages. So let's see how the percentages will look like, and let us do the comparison. Those are the four companies. Let us start with revenue. Dividing revenue by revenue will give us 100%. Yes, you are correct. So let's see the cost of sales. Regarding cost of sales, Zain had the lowest cost of sales, 41%. In other words, the cost of sales of Zain in 2023 was 41% of the revenue. In the second position, we have Mobily with 44%. The third position goes to STC with 48%. And finally, Go Telecom with 70%. Did you notice that the figures for Zain is 41, 44 for Mobily and 48 for STC, while it is 70% for Go Telecom. I guess the reason for that is that Zain and Mobily and STC are MNOs, mobile network operators, while Go Telecom is MVNO. So being a reseller of mobile network services, let it have that high cost. I'm not sure about that, but this is a guess. Let's move forward to the gross profit. Gross profit is equal revenue minus cost of sales. So for Zain it will be 100 minus 41 equal 59%. So 59% of the revenue of Zain is a gross profit. The second position we have Mobily with 56%. Third position for STC with 52%. And finally Go Telecom with 30% gross profit. Selling and distribution expenses. Go Telecom in the first position with the minimum selling and distribution expenses, 6%. Second position goes to STC with 8%. Third position goes to Mobily with 9%. And the fourth position goes to Zain with 21%. General and administrative expenses. Zain with 6%, the minimum. Second position goes to Mobily with 7%. Third position goes to Go Telecom with 9%. And finally STC with 10%. Other operating expenses. The minimum and the first position is Go Telecom with 1%. The second position, in the second position we have STC with 14%. And in the third position we have Mobily with 23%, and finally Zain with 24%. Total operating expenses, which is the summation of those three figures. Go Telecom in the first position with 16%, which is 6 plus 9 plus 1 equals 16%. The minimum operating expenses among the four companies. The second position goes to STC with 33%. The third position we have Mobily with 39%. And finally STC with 50%. Sorry, and finally Zain with 50%. We have seen that Zain had the highest gross profit, but it has the lowest cost of sales, but now we see that it has the highest operating expenses. Let's see what is the impact of that on the operating profit, loss or income. The first position now changed to STC. It was Zain in the first position when we calculated the gross profit. Now STC in the first position with 20%. The second position goes to Mobily with 18%. The third position goes to Go Telecom with 14%. And finally, in the fourth position, we have Zain with 9%. So Zain went from the first position when it comes to gross profit to the fourth position when it comes to the operating profit. Finance cost. STC has the minimum finance cost with 2%, 4% for Mobily in the second position, and 7% for Zain in the third position. Go Telecom did not report finance costs. Finance income. STC in the first position with 2.1%. Mobily in the second position with 1%. Zain in the third position with 0.7%. And finally Go Telecom with 0.2%. Share of profit loss of joint ventures. Mobily 0.2% in the first position. STC in the second position with 0.1%. Zain with minus 0.02% in the third position, and Go Telecom did not report share of profit of joint ventures. Other income expenses net 11.5% in the first position, Zain. Second position goes to Go Telecom with 5.3%. Third position, STC, 0.4%, and finally, Mobily with minus 0.2%. As a result, the profit loss before zakat and income tax, the first position is STC with 20.5%. Still leading. It was in the first position in operating profit. Now it is still in the first position when it comes to profit before zakat and income taxes. Go Telecom in the second position with 19.7%. Mobile in the third position with 15%. And Zain in the fourth position with 14%. Zakat expenses. Go Telecom had the minimum in the first position with 0.6%. In the second position, we have Zain with 0.9%. Mobile in the third position with 1.3%. And finally, STC with 1.9%. It's obvious from those figures that the higher the revenue, the higher the percentage of the zakat, not only the amount of the zakat. So, in other words, it seems like the percentage is not same for the different slabs of revenue. Finally, profit or loss or net income. Go Telecom in the first position with 19.2%. Then STC with 18.6%. After that, Mobily with 13.3%. And finally, Zain with 12.8%. If you notice that when it comes to the gross profit, Zain was leading with 59%, and Go Telecom was in the last position or the fourth position with only 30%. But the bottom line, which is the most important one, the net income, now Go Telecom is leading with 19.2%, and Zain is in the fourth position. It has been flipped. Just to repeat, 19.2%, it means that 19.2% of the revenue of Go Telecom is converted into net income. So this episode is prepared and presented by me, Muhammad Assir. I did MBA at Edinburgh Business School, Heriot-Watt University. I did MSc in Electronics Engineering with a specialism in telecommunications at SUST. Also BSc in Electronics Engineering with a specialism in telecommunications at SUST. BMB, ITIL 4 Strategic Leader, ITIL 4 Managing Professional, and 13 years of experience in mobile and fixed networks. Thank you very much for your time, and see you the next one.